powerful rally in long-dated bonds has sparked a sharp bounce in the US dollar and lit a fire under global risk appetite. But with the RBNZ decision looming and also limited signals from today's Aussie CPI, investors are watching closely for what exactly is next. Let's head to Adelaide now. We're joined by David Scupp, who's a market analyst from StoneX. Plenty of crazy weather your way, sir. And what's happening with the bonds?
Mate, it's just about as crazy as the bond market does. We've had the weather here in Adelaide recently. Yes, it's been remarkable. When I was on the program last week, I was talking about what was going on in the bond market, particularly longer dated bonds. So I'm talking about securities that go mature 10 years plus and how the yields have been backing up, rising very, very sharply, which is a really, really bad danger sign. Well, lo and behold, less than a week later, we've seen authorities, this time in Japan, go and act. And I've just gone and highlighted there in red, Japanese 30-year yields. And we've seen a huge rally in that. So that's looking at the yields. The rally is equated to about 6% over the space of a couple of days. That's nearly 40 basis points, which is a huge move in the scheme of things for fixed income markets. And you can see across the world, all those are 30-year yields across the country. Next door on the left-hand side to Japan is Australia's yields. It too is moving lower. So we've had this big move, and it was all sparked by a survey.
A survey. So talk to us about how the move impacted the US dollar and also risk sentiment.
Yeah, so what happened was basically you've got this big decline coming through in Japanese yields, and what that's filtered through is it's gone and helped to go and ease the pressure that we're seeing on US bond yields. Of course, everyone's been talking about the US fiscal situation and how it was deteriorating. It lost its credit rating from Fitch and Moody's and S&P as well, of course, over the past decade or so. And then all of a sudden, that makes the scarcity value a little bit stronger. And so what we're seeing is yields have come down in the US. It's alleviated those concerns, and it's led to a really big bounce coming through in the US dollar. And not only that, we saw the trade deal, the backflip from Donald Trump when it came to EU tariffs that was scheduled to be put in place on June 1st, scuppered earlier this week. And combined with that, and it's just created this really powerful move in risk. In US equities are flying. The local market here is flying as well. So risk appetite is roaring as we head towards June.
Well, if they love a risk, I mean, there's been so much going on. Let's talk about New Zealand, because the RBNZ, well, they've got their moves expected. Do you think it'll be more dovish than what we've seen from the RBA? Plenty of reporting around that house prices have really stagnated across New Zealand.
It is, and that's one of those impediments that might go and work in the favour of the doves and actually maybe see the RBNZ go and take policy, or at least signal policy, may go into stimulatory territory. So today, just to go and recap, we're expecting a 25 basis point cut, taking the cash rate to 3.25%. That will make 225 basis points worth of easing from the RBNZ this cycle so far. But the big interest is going to be, because that is all fully priced by the market, is to exactly what the bank will signal when it comes to the path of where it expects interest rates to go in the future. Last time they went and gave us an update 3 months ago, they expected that the rate would go and bottom around 3%. The key question now is we have a lot more uncertainty out there, particularly around US tariff policy. Will that go and make the bank go and deviate and go and signal that it needs to go and cut rates even more aggressively? I kind of lean against that. I think that it might go and hold off and be more data dependent. But that's going to be the key thing to look out for, Dave. The rate track path will be very, very important.
It's this kind of seesawing, isn't it? They pushed rates up to try and slow inflation post all the money that was in the economy post-COVID. And then now they're bringing it back down again. And the question is, will it be as sharp? Talk to us about the Australian CPI that comes out today, not as telling as it looks.
Yeah, so this is the monthly indicator. It's not the full gambit, the quarterly one that gets a lot more airtime and especially gets a lot more attention from the RBA. So this basically looks at a much smaller variety of price movements over the month. And the first month of the quarter, so this is for April, is very, very goods heavy. There's not so much services prices, which accounts for about 60% of the CPI basket. So there's limited information in there. And we know there's already a lot of uncertainty as to exactly what's going to happen with imports coming through from China. Are they going to go and divert them to other countries like Australia? And will it depress goods prices? So there's a lot of uncertainty out there. So I just think the information in this particular release today is going to be very, very limited. And if we do see a major reaction one way or another, I expect it will probably reverse pretty quickly. Indeed, I think there's going to be a lot more attention on the RBN decision, which arrives 30 minutes afterwards.
Yeah, really interesting to watch how they're handling this one. And as you say, there's so much happening geopolitically, including what happens to all of those exports from China that were meant to go to the United States. Do you think that will be a big factor?
Look, in time, I think it will be, unless there's a resolution which is really rock solid between the US and China, which I've got to say looks really, really unlikely at this point in time. You're going to have to go and see this diversion of what China makes to other parts of the world. We've already seen a lot of moves in the recent data from China showing big exports to the European Union, also to Japan. And you'd imagine that's going to go and filter through to Australia as well. And just given how much China manufactures and how big the US market is that it's going to try and have to go and replace, you'd imagine there's going to be a lot of supply, which probably will go and press downward pressure on prices.
Let's talk about the ASX 200 futures pointing to new record highs.
Yes, mate, it's been a remarkable rally, and again, it's going to have to be driven by the banks. So looking at here, this is the futures contract, SPY futures. And from a technical perspective, there's not a lot not to like at this moment. It is getting a little bit stretched. It's overbought on RSI 14, which is a momentum indicator. But just from a price action perspective, 8280, the price bounced off it really strongly, and then it's made to go and take out the highs that we saw struck last week, which to me just says the next stop is going to be the record highs. Now, I doubt it's going to come through today, but if it's going to be driven in the near term, it's going to have to come through from sectors that are not the iron ore miners in the material space, because we've got commodity prices depressed from the stronger US dollar. It's going to have to be the banks and probably that big yellow one, the CBA, doing the heavy lifting again.
All right, what goes down must come back up, as we always know with the markets. It has been a difficult 5-6 months for a lot of investors out there. So much going on with the turbulent Trump news, but David Scott always helping us to break it down and stay safe there in Adelaide. It's been a rough and wild ride for you all. Thank you.
It's great to be here, mate. Take care.